Summary of Investing Amid Low Expected Returns. Making the Most When Markets Offer the Least, by Antti Ilmanen, written and narrated by Janky Mind. Introduction. Navigating the intricate world of investing in an era of anticipated low returns requires a strategic approach. This guide not only highlights the importance of discipline, humility, and patience but also provides valuable insights into enhancing long-term returns through effective portfolio construction, risk management, and diversification. Whether you're an institutional investor or an active individual navigating challenging financial conditions, this resource equips you with the tools needed for success. Investing can often feel like maneuvering through a complex labyrinth, especially in an environment marked by low returns and high valuations. Success isn't just about high returns, it's about mastering the delicate balance between risk and reward. This challenging terrain demands more than financial acumen, it requires a structured and disciplined approach to decipher the nuances of various asset classes and strategies, ultimately building a resilient financial future. A refined approach becomes particularly critical in a market filled with overvalued assets and the elusive pursuit of alpha. In this audiobook, you'll gain essential guidelines and principles for navigating the multifaceted financial ecosystem. Discover the significance of a process-oriented approach, insights into various asset classes, and how to avoid detrimental investment habits. Embrace core principles like patience, humility, and realistic expectations, and understand the strategic importance of diversification in your portfolio. Prepare to delve deep into these insights and strategies, arming yourself with the knowledge needed to navigate the ever-evolving investment landscape successfully. Chapter 1: Navigating a Low-Return Landscape, Prioritizing Process over Results. In today's financial landscape, assets are yielding less, and prices are reaching unprecedented heights, creating an environment where future returns are expected to be subdued. The valuation of most assets suggests a departure from the abundant profits of the past, ushering in an era marked by reduced returns across a broad spectrum of assets. This shift in the financial climate may unfold gradually through prolonged periods of low yields or abruptly due to significant value adjustments. The challenge lies in the fact that many investors, buoyed by past successes, persist in anticipating high returns. In an attempt to maintain previous levels of profitability, they often venture into riskier avenues. While this approach may provide temporary relief, it is fundamentally unsustainable, fostering unrealistic expectations and a perilous reliance on past victories. Consequently, investors tend to adopt more precarious strategies, diversifying into riskier and less liquid assets to chase higher returns, an historical pattern observed during periods of plummeting interest rates. This pursuit, though understandable, is inherently risky and poses difficult choices in a low-return environment. Therefore, the focal point should shift towards solid investment principles such as discipline, humility, and patience. Emphasizing factors within one's control and improving processes become crucial, with a focus on strategic asset allocation and diversification over concentration and tactical timing. This shift represents not just a change in strategy but a shift in mindset, an embrace of Stoic philosophy, concentrating on realism and process over immediate results. Various types of investors, from defined benefit pensions to individual savers and endowments, are all grappling with navigating this evolving environment. The prevailing low returns are prompting many to reconsider their asset allocation, moving towards riskier assets. The collective pursuit of higher yields, in an effort to sustain return targets, symbolizes the current struggle to address the challenges of the low-return environment. The key takeaway is that adapting to this transformed financial environment requires a recalibration of expectations and strategies. A focus on evidence-based investment principles, realistic expectations, and a commitment to process over immediate outcomes are the guiding principles in this journey. These principles ensure balanced and successful investment endeavors, even in the current conditions of lower expected returns. The essence is to cultivate resilience and strategic thinking to efficiently navigate the nuanced intricacies of the modern financial landscape. To achieve this, a deeper understanding of various asset classes will be explored in the next section. Chapter 2: Strategic Navigation Through Diverse Investment Terrains, Unveiling Asset and Style Premia in a Low-Return Landscape. In the current investment landscape marked by notably low returns, a profound understanding of various asset classes and strategies is paramount. This chapter delves into the intricacies of investing, exploring the roles of liquid asset class premia, illiquidity premia, and style premia. In today's economy, interest rates on cash savings are near zero in the United States, and some countries even experience negative rates, reflecting expectations of low inflation and economic sluggishness. This poses a significant challenge for earning returns on investments. The equity premium, representing the additional return investors expect for investing in the stock market over safer assets, has historically been a key source of both return and risk. However, projections for the future suggest potentially lower profits on major investments due to current low rates, highlighting the need for a nuanced approach. Illiquidity premia, referring to additional profits from investments in less easily liquidated assets like real estate and private equity, play a crucial role. However, evidence on the substantial nature of these extra returns is not consistent. Investments in private businesses, historically more profitable than public ones, have seen a weakening trend since 2006. The analysis extends to style premia, encompassing value, momentum, carry, and defensive strategies. Understanding and applying these varied strategies can aid in managing investments wisely in different market conditions. In essence, comprehending the interplay between liquid and illiquid assets, coupled with a strategic application of style premia, is pivotal in navigating the low-return environment. Chapter 3: Deciphering Alpha, Navigating Complexities for Optimal Value Realization. This chapter delves deeper into the concept of alpha, akin to the extra credit in the investment world, representing additional returns beyond typical market gains. Determining alpha is not straightforward, it's ever-changing and tends to diminish as market competition increases. Differentiating between alternative risk premia, ARPs, and alpha is challenging, as both share an elusive nature. Investors chase unique signals aligning with alpha, requiring a balanced mix of traditional and novel approaches to optimize returns. Even as the shift from active to passive investment strategies occurs, active managers can still achieve positive alpha in certain realms. Recognizing the scarcity of true alpha emphasizes the need for thorough analysis of managers' performance, ensuring investors are not paying premium prices for standard returns. Understanding the transient nature of alpha and its relationship with ARPs is key for navigating the financial landscape effectively. To truly grasp alpha, a diligent and enlightened approach is essential, discerning the interactions between alpha and regular market returns, ensuring the pursuit of alpha yields real value and avoids the misleading allure of assumed returns. Chapter 4: Balancing Act, Leveraging Diversification for Optimal Risk-Adjusted Returns. As we delve deeper into the intricacies of investments, the significance of diversification, or the strategic spreading of investments across various asset classes, becomes evident. Despite being a potent strategy, diversification is often underappreciated and underutilized, with many investors concentrating their assets, predominantly in stocks. The power of diversification lies in blending different types of alternative risk premia, ARPs, that exhibit diverse behaviors, significantly enhancing the risk-return ratio. However, fully realizing the benefits of diversification may require the use of leverage, involving borrowed funds, an unconventional and potentially risky approach that may not align with every investor's comfort level. While diversification has proven benefits, it faces skepticism due to its lack of a one-size-fits-all guide and deviation from traditional investment models. Historical evidence consistently demonstrates that global diversification improves the risk-return profile of ARP portfolios, lowering risks and increasing long-term returns compared to a narrow market focus. Constructing a diversified portfolio often involves mean variance optimization, MVO, a technique aligning investments with preferred risk and return levels. However, implementing MVO requires crucial decisions, such as determining the allocation to less liquid assets and considering broader economic influences. Real-world applications encounter limitations related to leverage and liquidity, necessitating meticulous consideration to avoid errors and achieve realistic allocations. Creating a diversified portfolio is a complex process that demands an approach beyond relying solely on past data and existing models. It should reflect individual goals, preferences, and limits. Striking the right balance between diversification, liquidity, leverage, and risk entails navigating through multiple considerations, making the pursuit of optimized risk-adjusted returns a nuanced endeavor. By embracing diversification and informed optimization techniques, investors can establish a balanced approach, tapping into the full spectrum of opportunities in the dynamic financial markets. Chapter 5: Principles over Profit. Navigating the investment landscape with discipline and wisdom. In the pursuit of financial acumen and investment success, avoiding detrimental habits while fostering discipline and patience is paramount. As previously mentioned, successful investors resist the allure of immediate results, maintaining a steadfast focus on the process rather than chasing returns. Chasing returns often stems from impatience and the inclination to make extreme predictions. This approach, pursuing investments solely based on recent success, carries inherent risks, especially when those investments are poised for a downturn. Investors often fall into other harmful habits, such as insufficient savings, limited diversification, excessive trading, and chasing speculative, lottery stocks. Combating these habits requires building good practices, exercising discipline, patience, probabilistic thinking, and effective investment governance. Utilizing tools to adhere to commitments and reflecting on choices can mitigate biases. Studies underscore the consequences of these common bad habits. For instance, replacing underperforming managers with recent successes in pension plans often results in the terminated managers outperforming the newly appointed ones. This highlights the detrimental timing associated with investment decisions, observed in the propensity to allocate to past winners and the prevalence of overtrading due to overconfidence. In today's investment landscape, characterized by generally low returns and heightened speculation, prudent risk-taking is more crucial than ever, especially when there's much at stake. The essence of smart investing remains relevant, particularly in challenging times when efficient resource utilization is imperative. During periods of elevated asset valuations and potential repricing, adhering to key principles such as meticulous strategy selection, accurate risk assessment, strategic patience, expansive diversification, cost efficiency, and stringent governance becomes vital. Maintaining unwavering confidence in your chosen approach is imperative. As you navigate the intricate investment landscape, remember the importance of resilience, the pursuit of wisdom, and adherence to thoughtful, disciplined strategies. In a world filled with speculation and fleeting allure, let your journey be guided by enduring principles, ensuring a balanced and prosperous financial future. Summary. In a landscape characterized by low expected returns and elevated valuations, the imperative for investors is to pivot from outcome-focused thinking to a disciplined, process-oriented approach. Strategic comprehension of diverse asset classes and investment strategies becomes paramount for successful navigation in such an environment. This entails embracing robust investment principles like patience, humility, and realistic expectations. To thrive in this challenging landscape, it is essential to delve into the intricacies of various asset classes, unravel the elusive nature of alpha, and strategically apply diversification. The avoidance of detrimental habits, including overtrading and the pursuit of speculative, lottery stocks, is crucial. Instead, fostering an unwavering commitment to sound, evidence-based investment practices is key. This disciplined approach, coupled with a comprehensive understanding of asset nuances and adherence to enduring principles, empowers investors to navigate the complex financial terrains effectively. By doing so, they can ensure a balanced and prosperous financial future despite the prevailing challenges in the financial landscape. This audiobook summary was brought to you by Janky Mind. We hope you enjoyed it.